Aviation magazine that had this caption. It says, if you want the wrong answer...
If I had $1 or a ringgit for each time that pun has been used, I'd be a very wealthy man. Unfortunately, I haven't, but still. I just want to get a bit of a feeling... Pardon? Oh, the microphone, pardon me. Let's see, let's try this one. Okay. Okay, is that better? Obviously, yeah, good. Can I get a show of hands of who was at the conference yesterday at my presentation? Okay, but only a minority. So what I might do as a starting point, rather than starting with talking about illogical fallacies, I might go through the presentation I gave yesterday, just because part of what I was doing there was using the complex systems approach I take and applying it to Islamic finance as well as to mainstream. So I'll do that first of all, and then go to the micro. That sound reasonable? Okay. I also know I always speak too quickly. Okay, so I'm willing to be told to slow down, like I was willing to be told to use the microphone. Okay, so I had my first exposure to Islamic finance 20 years ago because there was a colleague in the accounting department at the University of Western Sydney, Omar Zaid. And Omar and I got on very well and decided to do some papers about financial instability and Islamic finance, and also what does Iqtisad mean, what's the interpretation of economics in the Islamic world. So I got some exposure that way. And when I was asked to give a presentation at the conference, partly about economics in general and why it's gone so badly wrong, but also about could Islamic finance avoid the instability of capitalism, my expectation was I'd model and find the answer to that question was yes. Well, I actually found it was no, but not in terms of the entire idea of Islamic finance, but simply the idea of replacing debt-based money with risk-sharing money, effectively. And what I found was that that wasn't sufficient. So I'll go through the presentation now. Let's try. Is that better again? Okay, good, fine. I'll push this. I can turn that one off now. Okay, good. Right, so what we've found in economics, of course, is a huge shift from a level of extreme confidence about that they knew how capitalism functioned to really almost, I think at the moment you'd call a state of despair starting to hit the economics profession. And what I often find is these things begin at the top in many ways. The people who get disillusioned with the state of the theory are often the leading theorists first. The people who are still doing the nuts and bolts tend to continue believing on. So I want to talk about a bit of the shift that's occurred at the very top of the profession. If you go back to not 2003, you'll find when Robert Lucas became president of the American Economic Association, this was the confidence he had that macroeconomics, as he had developed it, had solved the major economic problem of avoiding depressions. So this is in his presidential address, and saying that his thesis is macroeconomics succeeded, depression prevention has been solved for many decades. Well, of course, 4 years later, that claim collapses. But before it happened, one reason they thought they'd tamed the avoided financial crises was this phenomenon of a declining volatility in employment and inflation, which they called the Great Moderation. And Ben Bernanke was a particular fan of this phenomenon, and also particularly willing to take credit at the level of the central bank, in any case, for the fact that it had occurred. So he talked about how recessions had become less frequent, milder, volatility had declined, and he believed that was because of better control of inflation, which of course was the central bank's ambit. And he literally called it, as you see there, the welcome change in the economy. So it was seen as being a very, very positive sign. Of course, the crisis then hit a few years later. You could find that the closest mainstream economic claim I found to the crisis itself, saying how wonderful 2008 was going to be, was June of 2007 by the OECD in its quarterly economic outlook. So right up until that stage they thought 2008 was going to be fantastic. Of course, by the end of 2008, this is Hank Paulson as Treasury Secretary telling the Congress that they needed hundreds of billions of dollars, and he said the only reason he didn't use the word trillion was to avoid causing cardiac arrest. But of course they did finally start getting trillions of dollars to bail the economy out. And when he was asked what would happen if he didn't get the money, his answer, and he's quite a religious man, as you're probably aware, was, "May God help us all." There really was a belief capitalism was going to fail if they didn't get that money. Of course, the banks certainly got the money instead. Now, when you look at how macroeconomics reacted to this, first of all, there was shock. And I'll give a personal anecdote here. I met Ed Lazaire, who was the Bush's chief economic advisor in about 2009. Very nice man, I must say. But Ed told me that the state of mind inside Bush's cabinet when the crisis hit and they realised how severe it was sheer panic. They completely abandoned any economic theory. It was just, they believed that if they didn't do something gigantic, capitalism could well fail on their watch, and they would be blamed for the collapse of capitalism. That's just how deeply they were scared about what was going to happen. Now, but after it, when you looked at how initially macroeconomists tried to cope with the fact that they hadn't seen the crisis coming, their explanation was that if they just built a range of stronger shocks into their model than they used for previous recessions, they could model the dynamics of the Great Recession. So this is Peter Ireland, Peter Ireland, saying back in 2011 that the crisis was just due to bigger shocks coming along than in previous recessions. So it was just the shocks, technology and preference shocks. I want you to keep that in mind because I'm going to give you an interesting quote from Paul Romer later on in the presentation. But a decade after that, that complacency is gone, not at the level of the foot soldiers of economics, but at the level of what you might call the high priests. So my first exposure to just how dramatic a shift was happening in economics came with Narayana Koshalakotta, who was the president of the Minneapolis Federal Reserve. And that's one of the provinces of the distinction between freshwater and saltwater economics. Well, this was freshwater, very conservative, believing capitalism was inherently stable, minimise the government role, all these sorts of arguments. And just in July of this year, only a few months ago, he said the premise for serious modelling, by which he means building dynamic, stochastic, general equilibrium models of the economy, was that there's a well-established model of theory. He said, in my view, after the highly surprising nature of the data over the last 10 years, is this premise is wrong. We simply do not have a settled, successful model of the macroeconomy. Now, that's quite a severe shift in the belief they have in the accuracy of their own models of the economy. And Blanchard is another person who's gone through a remarkable transition. He published a paper 1 year after the crisis began, which is called The State of Macro. Has anybody read that paper or seen that paper? I do recommend taking a look at it because he actually says at one point the state of macro is good. This is in August of 2008 when it was first published. August 2016 is now saying this: the models have become dominant in macro research, and this is the usual argument that they're a mature science organised around micro foundations. He said others see them as a dangerous dead end, which he acknowledged to some extent but very superficially back in 2008. Now what he has to say is there's reasons to dislike those models. And what's the reason to dislike them? He said they're based on unappealing assumptions. And of course often neoclassical economists would reject any criticism of assumptions and saying, well, assumptions don't matter, or you have to make simplifying assumptions, etc., etc. What he was saying instead is they're not just simplifying, they're profoundly at odds with what we know about consumers and firms. And I'm going to go on and elaborate that in the part of the presentation where I start talking about microeconomics and how badly grounded micro itself is. And of course macro is based on a very, very bad foundation to begin with. So he's now willing to reject those assumptions. But the most remarkable paper of all, and I'll leave the presentation behind so you can go and click the hyperlinks and go and see these papers, is one by Paul Romer, who's of course developed endogenous growth theory with very major contribution to neoclassical thought. He keeps on being suggested as a possible winner of the Nobel Prize within the paradigm. I'd be delighted to see him get it now, given what he's saying at the moment, because he wrote, and this is literally, what are we? That was a month ago, literally a month ago. For more decades, macro has gone backwards. And talking about what the models do, he says they attribute fluctuations in aggregate variables to imaginary causal forces. Remember the earlier statement I showed you where Ireland was saying preference and technology shocks. what on earth are they? Okay. And this was what Loma elaborates in this paper, and then said that the relationship they have with facts is so non-committal and so evasive that you couldn't even call it postmodern. And I'm pleased to say that I agree with Roma completely in criticising what's called postmodern philosophy. I think it's an intellectual disaster. But he said economic models are even worse. He suggests they should be called post-real. Yeah? Not even related to the real world in any meaningful way. Now, that's a very positive development from my point of view, because I've been saying much the same for 40 years. And in fact, if it's quite possible I could have put my name to that paper that Roma wrote, and people that say it's typical Keane, doesn't know what he's talking about. What would he know about economics? And then, of course, it's actually Paul Roma who wrote those comments, which has been wonderful. But going back to Olivia Blanchard and talking about how you do macroeconomics, a major reason why they tried to develop the microeconomic founded method in the first place was the belief that you had to start from some accepted set of principles that nobody could disagree with. And their idea was those accepted principles were microeconomic. And even after the crisis and the models that they built failed to see the crisis coming, there's still this belief we should start from this accepted core. Now, I actually agree that we should start from an accepted core, but I reject that it should be microeconomics. And there's two reasons for that. One is that you simply can't do it. You can't do it by extrapolating from the micro, and I'll talk about that in more detail in the second half of what I'm talking about this morning. But the other is that their micro is wrong. Okay? You cannot build a model of the real world starting from a model of the unreal world, and that's fundamentally what they've done. So he still thinks you've got to start from micro foundations, and comes down to saying that we have to start from a model of a perfectly competitive model and make changes to make it more plausible. Not because it's obvious that you can prove that's the right point to start from, but you see what he's saying there. Where else? Well, there is a where else, and I want to show you that fairly easily. First of all, you can't derive macro from micro, and I might repeat myself a bit this morning because I want to go through this Islamic extension of what I've done so far, but I'll come back to that in more detail later on. But you can work directly from macroeconomic identities, and what I'm showing you here is the approach that people who work in system dynamics tend to take. When they're building a model of a system, they start at the aggregate level, and they then talk about the relationships between the entities at the aggregate level, and you can drive a very effective model at that scale. You do not need to work from micro foundations. It's an economic fetish, I think, which goes right back to Adam Smith, that you have to start at that level. If you go one generation of economists earlier to the physicocrats, they began from the aggregate level, and I really think we should go back to the way they thought and build from them rather than from Adam Smith. But let's take a look at why you can't build from micro foundations up. And again, I might jump over some other slides later on this morning. This is quoting from a Nobel laureate in physics in a wonderful paper called More is Different. And again, the link is there. It's very easy to find that paper on the web. And he was writing, as you can see, over 40 years ago, and distilling the wisdom that had come out of extensions to the reductionist approach that science had taken to that date when they started to discover complex systems dynamics. And what he saw happening as a tendency in science, which scientists at that stage were beginning to abandon, was the initial belief that if we work out quantum mechanics, we can then derive Newtonian from quantum mechanics. Well, 40 years ago they realised they couldn't do it. 40 years later they still haven't done it. And what he said is, what you're doing is taking what was an effective strategy at the beginnings of science, of reductionism, taking a large system and breaking it down into components to try to understand it. But he said it doesn't imply constructionism. That doesn't say that once you've worked out what those components do, you can't extrapolate from those components back up to the aggregate level. And in fact, that's what economics has been doing. Now, economists also proved this to themselves even before the physicists did. This is a paper from 1953, which is I know it's 63 years ago because I was born that year. I know my own age. And this is not I'm quoting from a subsequent paper, but the very first proof of this was done in 1953. And this is in taking the idea of a utility maximising individual from which you derive a downward sloping individual demand curve. The question was, can you aggregate this to get a downward sloping market demand curve? Now, what people who don't think deeply enough about it think is, oh, you just simply add horizontally. But the point is, to derive that model, you're presuming that changing prices does not change the income of the agent whose demand curve you're deriving. To do it in a general equilibrium way, you have to acknowledge that by changing prices, you also change incomes. So that pivot point that is used to derive the micro idea of a downward sloping demand curve does not apply anymore. And when you do the mathematics fully, this is the conclusion they reached, that market demand functions need not satisfy in any way the classical restrictions on consumer demand, meaning, expressed very badly, but meaning you do not get a downward sloping market demand curve when you aggregate downward sloping individual demand curves. And I'll go through an explanation in more detail in the other presentation later, which means you can't even derive a market demand curve that's negatively sloped, let alone an aggregate demand function in the same way from the components of neoclassical theory. That doesn't mean market demand doesn't fall as price rises. It's an empirical regularity that applies to most commodities. It simply means neoclassical theory, which makes that an absolutely crucial part of its own logic, cannot derive it from its own first principles. And then if that's what you find, then you should change your logic, but they haven't changed the logic. Now, I want to show you can actually derive a useful macro model by working from macro identities. And the difference in working from macro identities is that there's no aggregation problem. I'm simply talking at the aggregate level and taking three definitions: the rate of employment, the wages share of output, and the private debt ratio. So that's number of people with a job divided by population, the wage bill divided by GDP, and the private debt level divided by GDP. So they're all aggregate to begin with. There's no problem with aggregation. I'm starting at that level. If you put them in dynamic form, I'm going to use lambda for the employment rate, omega for the wages share of output, and D for the debt ratio. You get three dynamic statements that are true by definition. Simply differentiate those with respect to time. Bring in labour productivity as well, which you need to do to bring the whole thing together. And you can then prove that the employment rate will rise, so the percentage level of the employment sector is a percentage. That will rise if economic growth, also expressed in percentage terms, exceeds the sum of population and labour productivity growth. So that's why I'm using the identity equation rather than an equal sign. So that's the percentage rate of growth change of employment is equal to the percentage rate of growth of GDP minus the percentage rate of growth of labour productivity and population. The wages share of output will rise if wage rises exceed growth in productivity. So I'm not presuming any Phillips curve here. I'm simply saying if that's what wage rises do, if wage rises exceed labour productivity, then the workers' share of GDP will rise. And the final one is the debt ratio will rise if the rate of growth of debt exceeds the rate of growth of GDP. That's obvious. So those are three definitionally true statements. Now, one insight from complex systems theory, which is the approach that I take to economics in general, is that it's not important to define each of the individual entities precisely to begin with. What is important is to get the relationships between the entities correct. And then a very simple definition of the behaviour of those entities will give you most of the behaviour of the system, because it's the interaction between the variables that gives you its behaviour, more so than the isolated behaviour of each entity. And that, again, is very different to neoclassical thinking. So I'm going to start from arguing simply there's a fixed relationship between capital and output. Very aggregate, something people think reaches the Cambridge controversies. It's very, very simple. But just to show you what you get with that simple starting point, a constant ratio of output to labour. So labour productivity, that's making labour productivity a variable, but simply saying, defining labour productivity as the ratio of output to labour. A constant rate of depreciation, so the rate of change of capital is gross investment minus linear depreciation. A constant rate of growth of labour productivity and population growth, so the rate of growth of labour productivity I call alpha, and the rate of growth of population is beta. and having debt simply financing investment. So I don't have any Ponzi scheme behaviour going on here, and I have no borrowing by households either. So I'm simply saying all debt is used to finance investment, and investment in excess of profits means that debt rises. If profit exceeds investment, debt's paid down. And then a linear Phillips curve relation, so I'm now bringing in a behavioural idea, simply saying that workers' demand rises are based on the level of employment, and if that's greater than the rate at which they don't make any wage demands, then their wage demands are that gap multiplied by a slope parameter. Very simple. And exactly the same thing for investment, to say the gross investment is a function of the rate of profit, and that again, if the rate of profit exceeds a level at which capitalists don't wish to invest, then you get zero investment. If it's more than that level, then they'll invest with a slope parameter that's similar, the same sort of idea as you've got for workers with wage demands. And consumption, therefore, is a residual. So I'm not modelling consumption at all. It's demand driven, but it's only driven by demand for investment by capitalists. There's no component for consumer demand yet. It makes it a much more complicated model to bring that in, which colleagues of mine have done recently, but I won't go into that there because it just gets to be horrific in the number of equations. So workers and bankers only consume, and they consume the gap between output and investment, and capitalists, who are firms, only invest, and they therefore borrow money if they invest. That's the simple model. Now when you put it together, of course you need a more elaborate model to do any fitting to data. But what you get is a model that has inherent nonlinearities, and this is I've put all the variables in red there, and the parameters in black. And if I was going to go through a detailed lecture, I'd get you to all derive those equations. I know it looks a bit on the scary side, but that's a pretty simple model, because there's only 3 variables and 9 constant parameters, and so there's no exogenous shocks. It's an entirely deterministic model. Now, and what you get out of it, this is why I say they're inherent nonlinearities. Here's in the first equation, which is the rate of change of the employment rate. I have the employment rate multiplied by the negative of the wages share and the debt ratio. In the second equation, you've got the wages share multiplied by the positive of the employment rate. And in the third, you've got the debt rate multiplied by, which is negative, times the negative of the wages share and the negative of the debt share itself. So there's a genuine quadratic there, as well as what you call quasi-quadratics. Now, putting all that together, you wouldn't think that a model that simple could give you any real insights. But what it does do is it generates both a great moderation and a great recession. And that's something you can't do with a neoclassical model. Well, nobody's done it with one yet, without just using shocks to make it fit the data. So what you get are 2 possible behaviours for the model. And I'm now showing you one of the 2. And that is that this is where it converges to equilibrium. So the cycles in the employment rate and the cycles in the debt ratio are slowly converging to equilibrium values over time. But if I change the slope parameter for the investment function and make the capitalist more willing to invest, which you would think is a good thing, what you get is an apparent moderation followed by a breakdown. Now you can't get that out of a neoclassical linear DSGE model. Certainly one that's deterministic could not give you anything like that. But this is a deterministic model. So what's going on in the model, and I'll bring it up here in my Minsky software, which is open source, by the way. Has anybody actually downloaded Minsky? Great, okay, good. We're still working on it. I still need funding to keep it going further. But what it lets you do is define equations as the flowchart, just to show that's actually not a static diagram. You can move components around, you can change values. I can make the accelerator larger or smaller. I can do that during the simulation as well. And I'll start by setting the slope of the profit function to a very low level and simulate. And what you get over time is you can see those cycles converging to a nice, comfortable equilibrium. And that's fundamentally, without knowing it, that's what the neoclassicals extrapolated forward from the period from 1980 to 2007, believing it's going to go on forever and we're just heading towards a nice stable system. Now, all I have to do is now change the value of that capitalist investment function, and I'll slow it down a bit here. And initially it looks the same, and those cycles seem to be getting smaller. But notice what's happening down here. The debt ratio is continuing to rise. And now the cycles start to get larger. You can see it very much in the phase diagram. If I keep it going on for long enough, the system will collapse. And what's actually happened is the debt ratio continues to rise. You end up with a level of debt that overwhelms the capacity of capitalists to finance their borrowing, and the economy collapses. So that's what's actually going on there, just giving a bit of detail. What you also can see, I don't think I actually cover it in this diagram, but what's actually happening as well is a shift in income distribution. Capitalists are getting fluctuating around a constant amount for most of the time, even though they're the ones borrowing the money. So the rising amount of money they're paying to bankers is offset by a falling amount they're paying to workers. And so you see rising income inequality as a sign of a breakdown approaching in the economy. So it's a causal explanation for the rising level of inequality, and it attributes that as a signal that we're going to have a financial crisis. Again, it's very different to what you get out of, again, neoclassical attempts to understand what happened before the crisis occurred. Now, that's a model that, as you saw, if I just go back to it, I've defined that using exactly the equations of I've shown you the ratio equations here. Reading this equation backwards, that's saying the rate of change of the employment rate is the employment rate multiplied by the profit function divided by the accelerator, which is part of the level of investment, minus depreciation and technical change in labour productivity. And as equations, if you click on the equation tab, you'll see that flowchart defines the same equations I showed you a moment ago. So whatever you do in Minsky, using the wiring to build it, it's building the equations in the background. And at some point we intend making it working both ways, but again that takes more funding for my computer programmer to get that done. Now if I bring up, this model here is done in flowchart form, so rather than expressing the model as a set of aggregate relationships, I'm now doing it at the ratio relationships, I'm now doing it at the aggregate level. So I'm saying here that real gross investment minus depreciation gives you real net investment. If you integrate, it gives you the level of real capital. Multiply that by the price level, you get the nominal value of capital. Divide the real capital level by the accelerator relationship, you get real output. Divide that by labour productivity, you get employment rate. Divide that by population, you get the level of employment. Divide that by population, you get the employment rate. That is then fed into a wages function, which can be linear or non-linear. I'm using a non-linear one here. Multiply that gives you the nominal wage. Multiply that by labour, you get the nominal wage bill. Subtract that from output and also subtract interest levels, you get net profit. Divide that by the nominal value of capital, you get a profit rate. Feed that to an investment function, you then get gross investment. So it's a causal analysis. And if I now simulate this model, you get still an incredibly simple model, which gives you some of the key phenomena we've seen recently of a rising level of private debt to GDP, driving a declining level of wages, so the inequality is rising there, inflation turning to deflation, and what looks like stability in employment giving way to a collapse in employment. This is without a government sector, by the way, which I have added in a government sector in simpler models, but I haven't yet built it into this price-based model. And what looks like stable incomes for capitalists all the way through until the very end, when the rate of increase in the debt ratio and the fact that deflation is occurring overwhelms the fall in wages share, and finally profit share starts to plunge. So that's, I won't say it's a simple model, but it is a simple model to build. It's very much a basic beginning model. And that's enough again to capture what we've seen happening in the financial system. It gives us inherent cycles. The cycles are not due to exogenous shocks, it's inherent. And just when it seems the cycles are over, the great moderation, everything collapses. And what's causing the crisis is rising levels of private debt, and the last ones to know are the capitalists. So if you're relying just upon the rate of profit, you won't see this problem coming. You have to have a coherent view of the economy overall. So what you're seeing there is workers who, even though in the model I have only capitalists doing the borrowing, in effect the workers are paying for it through a lower wages share. And the question is, could you eliminate that problem using an Islamic finance system? Now, what I've done to model this is say, well, let's actually model money being created not by debt, but by equity. What actually happens when you do that? And it's easy to do it in one sense, because if you think about how banks create money, and I'll talk about that again in the rest of the presentation today, they do it by extending loans, which increases their assets, and creating extra liabilities, which is the creation of money. They then charge interest for doing that, and then the borrowers can repay. That's the basic dynamics of money creation in a debt-based system. But there's no reason why you couldn't create that with an equity position. So banks could take an equity position instead. So dividends payments would then replace interest payments, therefore you have risk sharing going on. Equity cancellation would replace debt repayment, so when capitalists accumulated a large amount of profit, they could use that to pay down the banker's share. And what you get is something like this. So banks would issue money which gave them shares in the firm in return. The firm would pay dividends to the banking sector, and the firms could cancel the debt when they had large amounts of profit, larger than they wished to use for investment. So it's quite simple to imagine that shift. But having done it, so I have to, rather than looking at a debt ratio now, I now need to have a bank equity ratio, which is the bank ownership of the economy divided by the capital, value of capital. And interest payments are now replaced with dividend payments proportional to the equity that the banking system has in the economy, and therefore capitalists get the residual. And if there's funds available for investment, they're also available for equity cancellation. So you say net profit is now capitalists' share of ownership of the means of production multiplied by the gap between output and wages. And gross investment in excess of net profit now increases bank equity. And if I do that with exactly the same functions I've used for the debt-based model, I get this model. So you've now got an additional set of nonlinearities turning up here. Exactly the same for wages share for workers, and a much more complex set of interactions on bank equity. So you might think that this would mean that there'd be a different dynamic, qualitative. There is qualitatively a different dynamic, but it doesn't prevent systemic crises. Now there's much, much more to bring in to cover Islamic finance than just risk sharing. Okay, there's also the idea of paying, redistribution of income, cancellation, delaying having to service your obligations and so on. But I haven't done a full picture. But is this alone enough to prevent crises? The answer is no. I'll just show you why by putting a simulation together. So if I simulate it with the same level of parameters for the debt-based system that I showed beforehand, which gave stability there, I get a stable outcome here. I've got the wrong word there. That should be stable. But if I model it with a higher level of investment, then what you get is bank equity taking over the economy, and the same apparent moderation with a very sudden collapse. So it's the same pattern again in income inequality. With a low level of capitalist desire to invest, you get stable income shares. With a higher level, again, a falling income share going to workers is offset by a rising share going to bankers. So even though it's the firms doing the borrowing in the model, it's the workers who end up paying for it with a lower level of income share, which justifies what you talk about in terms of redistribution of income. Okay? It's a necessary part of avoiding the consequence that I'm showing here. So just having the debt showing is not enough. So just to show you that was the debt-based model I showed you a moment ago. This is the equity-based model. And again, the same story. If I put a low level here for the capitalist desire to invest, then you get equilibrium coming out of it. But if I have a higher desire to invest, and I don't need to go all that high, I'll just make it 8 rather than 10 as I did for the other case. You can see the breakdown dynamics as well. So it's not sufficient. So those are very simple models, but I think they illustrate the power of taking a complex systems approach to modelling these type of dynamics in our economy. And you cannot get those sorts of emergent properties out of the equilibrium assessed models that neoclassicals build. So what I can show by this illustration is that what can happen just with equity, with risk sharing, without all the other elements of Islamic finance, bank ownership claims can grow faster than GDP, just as debt can grow faster than GDP. Workers will be the ones who lose out, not the capitalists until the very end. So it's not enough. You need to have all the pro-worker income distribution ideas that are part of the philosophy as well. All you need ways to systemically reduce the bank equity share, which is the same as what I'm arguing for in the Western system, is we need a debt jubilee, what I'm calling a modern debt jubilee, to get out of the crisis we're in right now. And I think it's also partly what you'll find in the Islamic attitude towards usury, is an idea that in some way the banker's capacity to contribute to capitalism and therefore own part of capitalism is less worthy than what the capitalists themselves are doing and what the workers are doing, and that's justified because it's actually the simplest thing in the world, and I'll illustrate this in a moment in Minsky. The simplest thing in the world is to make money, as in actually create it. The hardest thing is to make a profit or make a wage. Okay? And particularly in the Western system with its attitude towards what bankers do and the exalted role it gives to finance, we give too much credence to the claims of the financial sector. And yet it's actually the easiest thing going to create money. So the capacity that gives them should not give them the control they can get over the system, and if they do, they'll bring the system down as well, which is what we're seeing in the West. So, as I said, it's only part of what you need to answer the overall question. These are some of the other elements that you need, but we have to abandon the equilibrium approach that neoclassical economics has. Now, I might actually take a bit of a break and take some feedback here before I go on to talking about why micro itself is wrong. So, please, any comments?
I would like to invite any comments if you have in your mind. Yes, please.
Yeah.
I'm not quite understand what you mean by the difference now on the Islamic finance, Islamic and equity model. This one is that you're saying that the bank is taking up lending or financing the money out of its own shareholders' capital. Is that what you're saying?
Effectively, yeah, because the banks, if you went to a purely risk-sharing approach to money creation, banks could still create money, but what they would get out of that creation of money is a share in the venture that they were co-financing, rather than debt which had to be paid whether or not the venture itself made a profit. And at the micro level, that looks a lot fairer, and you would imagine it would lead to stability. But what I'm saying is, if that also gives the bankers ownership of a certain proportion of the share capital, that's what they're effectively buying when they issue the loan, or issue the money, which in return they get ownership for, that ownership claim can overwhelm the economy.
My second question is, what is your view now that in Malaysia we are introducing what we call investment accounts, where these are the money that is supposed to be segregated or separated from deposit principal liability, and this doesn't require the banks to actually provide capital. So in other words, there is no equity ownership of the bank onto the financing projects that are being financed. So that is if the bank do not want to take any risks on any financing projects. One model. The other is if they want to have skin in the game, they can participate in the projects. Then they need to provide capital on their exposure. But the investment account would be risk bearing, as in, if there is any loss of the projects, then the investment account holders would bear the risk. So how is that with this model that you're saying? What will be the impact on the...
Well, that when you have people putting money on deposit with the bank and knowing that it's at risk, okay, then that does not create money. Okay, it simply it enables it's an arbitrage thing. The people who are putting the money there are hoping to get an arbitrage gain, but they might be getting no return. The bank's not putting a return up. It's where the money gets invested that might make a greater profit than the rate of interest for them. That's not a money creation mechanism. That's what you call loanable funds in the neoclassical. I've got a little camera here, a 3D camera. It just failed on this and just turned the thing off. They probably ran out of space on the chip, I imagine. Pardon me. That's not a solution to capitalism's overall needs for money, because that just recirculates existing money. So to me it's like building the textbook model that neoclassicals have of money as loanable funds and making it actually part of the system, but that's never going to increase the amount of money in existence. And we have a growing economy. It needs a growing amount of money. So it's not a solution. It's an alternative way of getting some finance for companies, but it's nothing like the same volume you get when banks actually create loans or create an equity share. Yeah.
Can I ask a question?
Yeah.
Okay. After me, okay, thank you so much. I'm very much interested in the fact that when you say about the rising inequality because of the rising debt and whatnot, yeah? And then because we have been paying banks, and then the proportion of the income would be lower and whatnot. But because we have been living in capitalism, and the importance of the debt in basically assisting in the growth of the economy, the importance of the bond market and whatnot. Yeah. So in your simulation or in your view, what would be the accepted level of private debt to the GDP and whatnot?
I'll go into some of that empirically later, but I think the basic level that I think is, if you think about a debt-based system or even an equity-based banking system, anything over 75% of GDP as a debt level is...
Malaysia is having about 55, so are we still okay?
Pardon? No, in fact, I want to show you, I might actually go across and show you that right now if you like, because that's another part of the presentation I intend doing today, but I'll bring up a little illustration of just how much trouble we are in with the level of private debt right now. If my computer would only respond to me. Let's see, hang on. I've pressed 3 times trying to get the file. Here we go. We're now going to get 3 copies of File Explorer. Wonderful. But I'll just bring up a little illustration I've done here. Because that whole question of just what is a sustainable debt load for an economy is an extremely important question. And fairly recently, a guy who's an American philanthropist who was a banker did an empirical study. His name is Richard Vague. He has a book called The Next Financial Crisis and How to Avoid It. But he did an empirical study of the last 1.5 centuries of economic crises around the world, about 150 crises over that 1.5 centuries as it happens. And he said every last one had a debt level of more than 1.5 times GDP and a growth in that debt level over the previous 5 years of 17% or more. So the ratio going, say, from 1.3 times to 1.5 or 1.5 to 1.7. Malaysia, according to the Bank of International Settlements right now, is running about 1.48. So I just want you to see this little demonstration I've built here using Bank of International Settlements data. And you can see, I'll just go right back to the Let's hope that works. Okay. I'm going right back to this. Let's see how far the data. Okay. So I'll go back to 1965, and I've got a range of countries inside. You can see the United States sitting there. So the size of the circles is the level of GDP growth, nominal GDP growth. The horizontal position is the private debt to GDP ratio, and the vertical position is the annual change in private debt as a percentage of GDP. Now, the higher that is, the more you're going to accumulate debt. So a high level here means you're going to go in this direction. And I've marked off what I see as the danger region, the level of private debt, above 1.5 times GDP. And with credit, which is the change, I define credit as the change in private debt. Okay? So I use debt and credit quite separately. Debt is the stock, credit is the flow. Okay? And if I now run this over time, I want you to, you'll see Malaysia's in here somewhere, it turns up at some point. You'll see it ends up getting in a fairly, it's been through a dangerous position level already. I think it's about to approach that again. So I'm now going through months, each year's data on a month-by-month basis. You can see Japan as the first country approaching this danger zone. And of course Japan had its crisis back in 1990. 1967, A68. Pardon the jumps and the visual, that's a flaw with Microsoft Excel every time I change years. Now, the late 1970s to early 1980s is when Japan started to get into what we call its bubble economy period. And you can see it passing in there in the early 1970s. It has now hit that 1.5 times GDP ratio. You saw Singapore popping up there occasionally with a much lower debt level. And now, in the late 1970s, Japan well and truly moves into that region. They have what they call their bubble economy period. Notice a number of countries that end up having financial crises later, like Portugal and the Netherlands are turning up there. Here comes the 1980s, and you'll see Japan goes right into that region. And when you first pass into this region, when the banking sector is really taking over and funding a whole lot of Ponzi financial behaviour, your economy appears to take off. Yeah, I know.
Didn't they have a crash that stock market?
They did, yeah. So we're into the 80s. Now, watch Japan. Just fly up here as 86 to 90 goes on. Norway, Denmark turn up as well. They had financial crises at similar times. Here goes Japan and Hong Kong. And now Japan hits its crisis in 1990, and it'll fall down out the bottom of that box. And when the circles turn blank, that's when growth is actually negative. You notice the Asian financial crisis approaching now. Korea, Hong Kong, Thailand, Malaysia all start to enter that region. Japan is falling off the edge, as you can see. Credit growth now becoming virtually negative. Here's the Asian financial crisis, Thailand, Korea, Hong Kong and Malaysia.
Is this the point where Finland actually falls below the negative region of the percentage private debt to GDP? So that means that private debt are not...
It's falling, yeah. When it's below here, it's negative. You now see Japan and Hong Kong have both had the crisis. And all the Asian financial crisis countries are now down here with negative economic growth and credit actually negative, falling rather than rising. Now we see the United States starting to move into this region. And Ireland. You'll see Ireland has some remarkable explosions in private debt. Portugal, all the countries we're watching having crises right now. There goes Ireland, what we called the Celtic Tiger at the time. Spain, Norway, Hong Kong, Sweden is in there. The United States is now headed. It's now falling out the bottom when the crisis hit. Ireland, hugely negative change in its GDP. That's the crisis itself. And now we see China and Hong Kong moving in there because their response to the financial crisis was to stimulate private borrowing. And that is Spain, Portugal, Hungary, Greece, down the bottom, negative credit. So change in private debt actually taking demand out of the economy rather than adding to it. And now we are approaching modern day. Oh, the data's disappeared. Great, now it's back again. Okay. So the countries that I see being in danger are obviously the ones inside this region: China, Sweden, Hong Kong, Australia, Korea, Canada, Belgium. But notice Malaysia, Thailand and Singapore are all coming back into this region again. So I think actually Malaysia is in the danger zone, or moving in that direction. You have several years where you can get away with it, because while the credit's expanding, then you can get a boom in the economy. But when you get up to this level and you start to have a decline in the rate of growth of credit, that itself drives demand down, and then you end up crashing out the bottom. So I think you're actually in the danger zone.
I have two questions, but let me invite Formula.
Yeah.
My question is
Okay.
It's here. It's not supposed to go. Okay. I think your structure for an Islamic economic system, of course, it reminds me of the counter arguments that I got when I put forward my own structure.
Mm-hmm.
One of the arguments that why do you want to have total reserves in an Islamic economic system?
Mm.
What does total reserves have to do with Islamic economics anyway?
Mm.
You see what I mean?
Mm.
No. All right. So I think you have your structure here has thrown some light, but because bankers create money,
Yeah.
they get more redistribution to their pay. Another thing here is that also the embedded redistribution in Islamic economic system, that's called zakat. Of course, I know that all of what I'm saying about the Islamic economic system has not been seriously applied. But zakat actually has two interesting things. First of all, we are doing redistribution every year because we know that even under the Islamic economic system, you cannot maintain an optimal or maybe desirable distribution of wealth. But the second thing here, which is zakat, also can be considered as a tax on monetary balances. Because you see, you pay 2.5% every year on all your outstanding monetary balances and nominal value.
Okay.
If they stay in your account or in your pocket for 1 year, 1 full year. So here, holding money is also placed distribution-wise at the disadvantage. So I think if you incorporated these two characteristics here, you might see something different.
Yeah, I think that's true. And that's what, again, that you could, with the framework I've built, you can simply, I wish I knew whether it's simply, but it's not difficult to add in those extra components. So you'd have the fact that there is a redistribution which goes back to the workers. And the way that I've designed Minsky, and I haven't put a presentation together on this front, but I'll just quickly illustrate the main reason I designed it. And that is that it's very hard with that flowchart paradigm to build models of financial transactions, because to properly build a model, show financial flows, you actually need to record them 4 times. And what we've done with Minsky is enable you to use double entry bookkeeping, the straight accounting idea, to show the creation of, show financial flows. So for example, if I create loans as an asset class, and let's say also reserves and also equity in terms of bank equity, and then have deposit accounts for firms, and got to make the table a bit wider here, and workers, pardon me, misspelling workers, and then have finally show the bank's own bank equity, let's call that BE, and then have things like lend money, and I have those loans going from here to the firm sector, and then paying wages, which is a payment from the firm sector to the workers. If I keep on going, I'm actually defining a set of differential equations that show those flows. And you could also build in, as part of your transactions, if you're required to pay money back like at 2.5%, then that'd be based on the level you've got of outstanding financial assets owned by the banking sector and so on. So you could build a more complete model of Islamic finance, and those redistribution feedbacks would probably prevent the type of, there would certainly attenuate the build-up of bank ownership that I showed happening in the model, which causes a crash. Yeah. One question? Yes. Yeah, yeah. Way at the back there. So, yeah.
Thank you, Professor King. 2 questions. Number one, under the current system, economic structure, if let's say, as you said, the level of debt as well as the impact on the level of workers' share in the economy, the 2 important indicators of an impending collapse. In the case of if there is an active role of the government to push up the workers' share of the national income, for example, through minimum wage, or to other means like cash transfers and so on, and also the regulatory framework from the central bank, for example, to curb the expansion of the credit. Will that help to stabilize?
It can to some extent. I've actually modelled the government sector in another set of models, which I'd have a hard time finding on my computer right now, but I can track them down. And that does show that if government spending effectively goes to workers, then spend it buying money from the corporations, so long as the government defends a minimum level of unemployment or a maximum level of unemployment, then you get continuous cycles, you don't get a breakdown. So it can work at that level. But to me, the thing which we need to add is we need to focus on the level of debt as another economic indicator, as important, if not more important, than inflation and employment. So actually target debt directly, and you do what's necessary to reduce the debt. In the Islamic system, you do what's necessary to prevent the financial sector owning too much of the productive resources of the economy. So you have to include that as well. When I included working on a more complicated model right now with price dynamics, where for the government sector does effectively like unemployment benefits to workers, that can give you a rate of collapse which is so great the government spending can't counteract it. that the rate of decline from the excessive debt can overwhelm the government's own response, and you still get a crisis. If you directly target a level of debt, then you prevent that crisis, even if you don't give the money to workers. So I think we need to include, economics has left money and banking and debt out of its thinking. And if we include them, one of the conclusions is you must target the level of private debt as a seriously important indicator of the health of your economy. And more than about 70% of GDP, you start getting in trouble. Of course, at the moment, most of the world's in 2 and 3 times that level of private debt.
You see, there is just one point with respect to that.
Yeah.
Can I just add a little bit point, a small point with regard to debt here. You see, debt results in the Islamic economic system from financing the acquisition of goods. In other words, either financing supply or demand and supply simultaneously.
Yeah.
See what I mean? And another thing here is that once the value of debt is set, in other words, in the transaction, it cannot increase. You see, in a conventional economic system, the volume of debt is just the rate of we calculate compounded interest on the outstanding volume, outstanding balance. If debt is not paid, it revolves automatically. In the Islamic economic system, debt has to be killed on maturity. There is no way to revolve it, and it does not increase. So actually, debt here is created just within the limits of real transactions, real sector transactions. You cannot exceed that at all, and has to be extinguished before maturity, and cannot increase. So this is also maybe subtle, but it's very significant in limiting the growth of debt.
Yeah, I better get your question. Yeah.
We'll get back to Dr. Nizam, and I also have one question from Dr. Irwan now. Yeah, but can we just
So, I have
I'll ask the brother. I'll get back to you, Dr. Nizam. Okay.
From all that I've heard, so the money creation function of the bank seems to be deeply destabilized.
Yeah, but it's also necessary for growth.
Yeah, so is there a way to tame it? There's these other proposals that governments create money.
Yeah.
And I think I've watched a lot of YouTube talks. You criticize that on the basis that banks will get around any kind of regulations that limit that power. And there's another critique of that the information gathering, this idea of it being disseminated rather than being centralized. So disseminated information gathering is better. But if that natural function of those private entities is to just create that no matter what, increase it no matter what, how relevant is that information dissemination factor to the problem?
Yeah, it's there's no easy solution. So I'm not talking about a panacea, but I think a lot of people do try to come up with a single bullet panacea for the problems of the financial sector, and that's often things like, let's take away the right of banks to create money at all and give it to the government. I think the government should play a major role in creating money, and it should be providing it for infrastructure and welfare and all those sorts of things, and that provides the money that the private sector needs to run commerce anyway. But I wouldn't want to have government bureaucrats deciding who gets money for innovation. I've had enough of being an academic and going for research grants and getting them turned down 9 times out of 9, and seeing the sort of nonsense that happens in terms of bureaucratic layers of decision making, and the whole emphasis in a bureaucratic system is to avoid making a mistake. Well, I mean, my favourite ever example of that is on a personal level, as I was involved with a trade union in Australia that was manufacturing a new fighter training training aircraft for the Air Force, and the Air Force told them how to design it, and the design specifications were one bunch of engineers had to draft designs which had to be approved by a second bunch of engineers before anything could be built to avoid waste. And that was supposed to be a 30-day cycle for each diagram. The average length of time for the feedback was 305 days, not 30. And one of the favourite instances they gave me as a demonstration of what happened, that after one bunch of engineers designed a set of diagrams and a second bunch examined them and approved them, and the aircraft gave the okay, when they built the flanges for the rudder, the flange was on the wrong side. Okay? Yeah. So, and seeing bureaucrats decide I'd rather have people actually do want to take risk. I mean, as much as you talk about risk sharing, I like the idea of venture capitalists where their assets are on the line for what they're doing, and they're also making decisions, and they're actually willing to take risks and willing to waste money, lose money. So you need that element as well, and that's what Schumpeter spoke about as what he saw as the role of banking, that idea of actually assessing what they think might work and funding entrepreneurs. So something that enables us to do that, and the straight handed over to governments doesn't enable that to happen. A whole lot of other things are possible these days. We could enable people to have a right to create a certain amount of money which they have to put through crowdfunding systems like Indiegogo and Kickstarter and so on, that sort of thing. That's another way to go about it. It's something that means there's a willingness to waste which generates part of the money that gets it to entrepreneurs. I think we need that as well as just trying to set it down. I think that would cause one of two things. A, banks would try to get around it. B, you might find there's not enough innovation taking place, and we actually stifle one of the good things of capitalism, which is the impetus it gives to people to innovate. So it makes me slightly rather cautious. I'm on the advisory panel for Positive Money in England, which is one of the groups that wants to have 100% government-created money. And I'm very willing to discuss with them, and I like them as people too, which is very important, but I'm not convinced that's a panacea.
Dr. Irwan, would you like to ask a question?
Thank you very much. I just wonder when through Islamic finance, you mentioned that the banks are now doing equity financing instead of doing the debt method. How would this then still contribute to the money creation? Because it seems that equity financing should be more closely related to profit creation. And my second question, can you clarify further, from the Minsky software, even with this equity financing, you showed that the capital, the bank share, it continues to increase, while the capital share seems to be stagnant. While it's supposed to be that through equity financing, shouldn't be that the share of the capitalists who contribute to this equity financing, shouldn't they also be increasing?
Should they
also going up, because they are the one that contribute this funding to the banks. On what basis would it be logical that the share of the banks will continue to go up, even though they are just kind of a partner in that equity financing?
Well, because banks can create money, bank creation of money is, if you think about bank accounts, the sum of all bank accounts being money, then when a bank issues a loan, increases its assets on the one side, it increases its liabilities on the other, and that's how it's creating money. With the idea of looking at equity-created money rather than debt-created money, when they did the loan to a firm, what they would, the firm normally effectively is like selling a bond to the. If you think about when a firm borrows from a bank, it's fundamentally like it's issued a bond and sold the bond to the bank and the bank gives the money back for it. That's the basic model. What I was saying with an equity-based system, it's like the firm issues shares, sells the shares to the bank, and the bank gives the money back. So both are ways to create money. That can be done. But if you imagine that capitalists are perennially optimistic, perennially, there's a boom going on, want to invest more than they've got in retained earnings, then they've got to issue more shares to the bank and to get more money back from the bank in return for that. But each time they issue the shares, they're handing over ownership of their capital. Now, what I've got in the model, which of course is too simple at this stage, but it's to illustrate the dynamics, is that the bankers just consume. They don't actually invest. So if you have an increasing amount of the ownership of the equity of the country going to the banks, and the banks themselves aren't investing, then your rate of investment is going to decline. Okay. So the bankers will be taking a larger and larger share of a smaller and smaller rate of growth of the economy, until ultimately they're taking all of it. There's all consumption taking place, there's no investment, so the economy collapses. All very stylised, but that's the basic reason why you still have a collapse. And that's why I say you have to think about the ethical element. Who's working harder? A bank doing double entry bookkeeping or a firm making goods? It's incredibly easy to make money, physically make it. Okay? It's very difficult to make goods. We need to have that moral attitude as well and say that we can't let the financial sector take over the entire economy. And it can do it whether it's by debt or by equity. So you have to have mechanisms that mean the financial sector can't become the dominant element. Okay.
Yeah, but can I call for Dr. Nizam's question and I go back to you, Prof. We have the session has a very heated discussion now, yeah, and we are due for a break in about a few minutes' time. But Dr. Nizam, can.
Thank you, Mrs. Chairperson. Professor Kim, to my second question earlier, I would expect that you are not a supporter of a full 100% reserve system.
That's correct, I'm not, yeah.
So, is there any possibility of modelling it in scheme?
Oh yeah, very simple. I mean, the fundamental idea behind 100% reserve banking is banks no longer can lend out, create assets and create liabilities at the same time. They would have an account at the central bank, and then if they lent money, there'd be a transfer of money from that account to the private sector. So as they lent money, their amount of money they'd have available to lend would fall, and there'd be a physical limit to how much they could lend. And one thing about Minsky, which I haven't demonstrated yet, but I'll just quickly bring it up here. With this particular model, I've simply put that's like a private banking system here. I can then create another banking icon which becomes a central bank. And as mentioned, I had reserves there beforehand, as you saw. I'll just call this CB loans very quickly. And let's say that what are the liabilities of the central bank going to be? Well, the program knows that there are reserves shown in the system already. So I can now show that the reserves are a liability of the central bank. Pardon me. Okay. So by creating, I don't know what's going with a couple of errors turning up here. Either a mistake in the program or a mistake in what I've modelled there so far. But I can have the private banks having an account at the central bank, lending out of reserves. All that sort of structure is possible. So it's quite possible to do it. And that's the whole idea of the financial system as an interlocking set of balance sheets was one of Minsky's major intellectual contributions to how I think about capitalism. So the software Minsky has been designed to enable that to happen.
Maybe just a follow-up question.
No microphone? Sorry, yeah.
So maybe follow-up question to that. If let's say there's a problem with uncontrolled credit expansion at the bank, at the level of the banking system, and at the same time, too much creation of debt can lead to an impending collapse. Then, perhaps in addition to the current practice of having the capital adequacy ratio to meet certain level, we may want to introduce as a policy rule that certain level of debt or within certain level of range for the banking system in order to make sure that this credit expansion cannot go beyond and move the economy closer to the danger zone. Is that a possible policy implication on the part of the central bank?
It's possible, and I mean the trouble about that is that's what the banks are. I mean, if you're working in a central bank, you'd see it all the time. They're very good at evading those sorts of limits and creating off-balance sheet entities and so on to evade those controls over capital adequacy ratios. And even a capital adequacy ratio, if bank lending is inflating asset prices, there's a feedback that justifies more lending. So I think you have to have controls on the nature of bank lending and say, for example, that bank loans have to be based not on the value of the asset, but the value of the income flow generated by the asset. And you set limits on that basis. And therefore, in the case of housing, you wouldn't be able to lend for a house more than, say, 10 times the annual rental income of the house. And then make a link between the level of debt that's created and the income earning capacity of the asset, rather than getting the positive feedback we currently get between lending and the price of the asset, which is what gives us these runaway bubbles in house prices. So I think we need to be cleverer by realising the real problem with lending is the break between the level of the debt and the income of the purchaser. They'll always manage to bend that. They'll go from a 10-to-1 ratio to a 30-to-1 ratio, and they're gearing and so on. But if you limit the lending to some multiple of the income of what they're purchasing, which is, again, has got an Islamic content to it, they can't lend. They won't create asset bubbles anymore. Okay? So that's the danger, the asset bubbles they create by that sort of lending. And I've described my concept for controlling that as the PIL, property income limited leverage. So one of the great weaknesses in our system at the moment as well is that borrowers themselves want to have a high level of leverage, because if you're competing to buy a house and you've got the same income as somebody else, then the one of you that gets the high leverage will win the battle, which means we actually personally, as individuals, wish to have a high level of leverage. But that, of course, causes rising house prices, which sets off the entire bubble and leads to the sort of trap we can see globally. If instead there was a limit that said that no matter how much income you earn, the maximum amount you can borrow for buying a particular property is, say, 10 times the annual rental income of that property, then two people with equivalent incomes, the winner would be the one who saved more. Okay. And we need that sort of mentality in the public to break the public's desire to get a higher level of leverage, which is what actually leads to the problems we have in the first place.
I'm going to take just one more question before we adjourn for break. Yes, please.
Okay, then. Thank you, Professor Steve.
Oh, your microphone's gone off again.
My observations are based on the first part of the presentation about the derivation of macro from macro, not relying on macro. If you remember, before Alfred Marshall propounded this theory of downstream demand curve, he studied the behavior of some fishermen. He studied the behavior of some fishermen to propound this theory of downsloping demand curve, inverse relationship between price and demand. And of course it does work, with the exception of the snobbers, those who want to show up. When the price goes up, they want to buy more. The Bollywood celebrities, in the case of. But if we believe the ceteris paribus assumptions, other things remaining the same, and also the law of large numbers in statistics, then of course microeconomics does help in building up macro. Market demand curve still can be based on individual demand function, if we believe in the law of large numbers.
let's actually be answering that question to the next session, because I'm going to talk. I'll go to the micro issues and the validity of neoclassical micro, and after we have a break.
Okay. Because I have other questions on three assumptions. So.
Yeah. No, I just.
Employment rate, labor ratio, and also the private debt to GDP ratio.
Yeah. Well, those, to me, if you're going to model, this is partly coming back to the whole idea of whether you can actually do constructionism, as Anderson described it. Can you construct a model by extrapolating from the characteristics of an individual entity, which is largely what you get in Marshall's method? And the answer to that is no. And I'll show that in a bit of detail in the next part of the presentation. But you really can't do it, and it's a fallacy that only economists are still guilty of. You look at the intellectual disciplines that try to do modelling; it's about the only one left that still believes in constructionism, and it's about time we caught up with the rest of the world, the rest of the not the rest of the scientific world. It's about time we caught up with the scientific world and stopped doing constructionism.